A super simple investing solution that can change your life. The more aggressive you are with your life, the better the returns you're going to be getting. And the higher the risks. Hello everyone, Alex is here. I hope you're doing well. And let's break some rules today, where being aggressive makes you rich. Let's go. A super simple investing solution, is that something that people are actually looking for? I would think so. I had a discussion with a couple of my friends who are not into investing, or friends who actually do some investing via mutual funds, and they keep looking for some other ways how they can simplify it or how they can lower the fees and do that by themselves. But the biggest question that comes up all the time is that, how can I do it? How hard it is for me to do it? I don't know anything about this. Mutual funds give me all this security and simplicity. I can just send them my money or give them my bank account so they can withdraw my money on some regular basis and keep investing them. So then after 30, 40, 50, 60 years, I can retire with a huge pile of cash on my investing account that I can use and live worry-free. And that is sort of correct, right? That's the whole thing why the mutual funds were created. Besides that, managers also wanted to buy Lamborghinis and Ferraris and Bentleys all the time, and huge mansions with all the fees they're getting from all these people. I just throw it away, because for you don't care about those. You're actually not seeing that at all. You only care about your money, and you want this money to be working for you properly, and then also possibly retire early, not when you're 60 or 70, because then you're all wrinkled and then you have like 10, 20, 30 years. 30 is like a lot. Nobody lives till 100. So you have like 5 years left on your life, and all your entire life you worked like a horse 9 to 5 every single day. People keep working for their entire life. They keep investing and accumulating and saving all this money just to live stress-free for like 5 years. Well, okay, 10, 15 years, that's probably more realistic. And that is why, if you don't know anything about investing and how that works and how you can do it on your own, you go to mutual funds and do that with them, which is better than putting your money under your pillow or under a mattress and sort of save it that way, or even leave them on your checking account or savings account on your bank, where inflation is just gonna kill all that. Going with mutual funds is not that bad. But if you compare what you can do with the ETFs, with the low fee passive managed ETFs, that's crazy. But even that requires some of your time to manage it, to find what ETFs you need to buy and all that, how to make this portfolio very low fee and all that. I actually talked about that in one of my previous videos as well. You can check it out there. But what else you can do? You can go with a single one ETF for your entire portfolio and live stress-free and keep investing to the single ETF for your entire life. That's super cool, right? And let's quickly reiterate why all these one ETF solutions are actually great, especially for beginners, but also for experienced investors as well. Because they offer global diversification, they give you lower fee compared to mutual funds. They have a very low entry barrier. You can buy this ETF through different brokerage accounts like Questrade or Wealthsimple. It's a hands-free portfolio management system where you only invest in the one ETF all the time. And there are different types of this single one solution ETFs. There's a conservative one, there's a balanced one, there's a growth one, and also there is a full equity one. And that is the one I'm going to be talking about today. The full equity 100% in stock ETF that gives you the most amount of growth over time, and also for a short period of time. I think that all the growth you are getting sort of covers all the risks, all the potential risks you're going to be getting on top of that. Because in general, historically or anywhere else, everyone is saying that you need to diversify your investments, have something in stocks, have something in your fixed income and all that. And then that's how you make sure you're risk-free and your portfolio is risk-free as well. But if you go all in into stocks or in this way, a single ETF that has all the stocks in it, then your portfolio becomes sort of a little riskier than the one that has a little bit of a fixed income. Why? Because stocks are more volatile, they're more susceptible to market crashes or different market downturns. And why you care about those, right? So the thing here is that if you're investing for 10, 20, 30 years, and then say it's going to be a year where you decided this is the time, that's when I'm going to be retiring, so I'm going to start selling my investments and using them. Say that year is going to be like a market crash or some market downturn where the whole thing just started to plummet like 30, 40, 50%, whatever. Then you're going to be like, okay, all my stocks are going down, so my portfolio is going down with it. And if you had a little bit in the fixed income, you can get your money out of that, which is not going to be that bad if you get it from your stocks or equity portfolio. Why? Because the fixed income part of your portfolio is not going to go down in a similar fashion as your equity part. Usually, if the equity is going down by 30, 40, 50%, then your fixed income part is going to go down by 10, 15-ish% as well, which is still a pretty big downturn, right? So you better wait it out and start selling when you actually come back from that downturn. And the other part for this is that over time, over this 10, 20, 30 years of your consistent investments in, say, into this full equity ETF versus investing into the 80% equity or 70% equity and 30 or 20% fixed income, your overall growth is going to be way lower if you go with this fixed income portion of your portfolio as well. So all this growth that you're going to be getting from your full equity portfolio is actually going to cover all this potential market downturns that you might experience at the year when you start using your investments. Because what if the year that when you want to start to use your investments is going to be actually the bull market year and everything's just going up? That's perfect. You start using your equity part of your portfolio, right? As that can also happen with you. And it's very important to know what your risks level are and how you are susceptible to all those different risks and what you're going to be doing with your investments when the markets are doing some weird things that they were doing last year. That was quite an intro, huh? Now let's actually dive into this single solution ETF, a full equity ETF portfolio, which consists of a one equity ETF that you're going to be using for your entire life. And we're going to be looking at Vanguard Equity ETF. The ticker symbol is VEQT. This ETF portfolio comprises of 100% equity holdings, and this is the most aggressive one across all the other single ETF solutions. And this is actually a pretty new ETF on a Canadian stock market. They started to trade in January of 2019, so it's been a couple years since they launched, so we don't have a lot of history to look back and see how this ETF performed over the long-term period, so like 10 or 20 years, but they've been growing and improving their portfolio over the last couple of years. They grew their assets under management almost to $1 billion as of April this year. Looking at their portfolio and the stocks they're holding is actually very interesting data there. First, geographically, they're pretty well diversified. The biggest chunk of their holdings coming from the United States, around 41%. They cover Canada as well, around 30% actually. They also have Japan, China, United Kingdom, France, Germany, Switzerland, Australia, and Taiwan in their holdings as well. It is pretty good to see that their diversification goes beyond Canada first, but also beyond Canada and United States. This is very important when you're holding for a long-term period because you never know what's going to happen with US or Canadian market, so you better hold something outside of that as well. But also the other countries might actually perform better than Canada and US. That never happened before, but who knows? Looking at the holdings of this ETF, they include companies such as Royal Bank of Canada, Apple, Shopify, Microsoft, TD Bank, Amazon, Enbridge, this is my favorite dividend stock actually, Bank of Nova Scotia, Canadian National Railway, and Brookfield Asset Management Corporation. So you see, even their top 10 list of their holdings is diversified between US and Canada. So in terms of their actual stock and geography diversification is actually pretty good. Now looking at the sectors that they're invested into in their portfolio, we can see this picture. Financials around 20%, technology around 18%, consumer discretionary around 13%, industrials 13% as well, healthcare around 8.5%, basic materials and energy 6% each, consumer staples around 5%, utilities is very low around 3.8%, telecommunications around 3.6%, real estate is also pretty low, 3.2%. So they're very bullish on financials and technology. And actually these two sectors perform the best over the long-term period as well. Now looking at the performance of this ETF, as I said, we don't have a lot of data to look at. We only have a couple years, but even though within these two couple years, the performance, the annual performance they have is around 14 to 15%, which is pretty good start. We'll see what's going to happen with this ETF going forward. But looking at the stocks they have in their portfolio and the returns of those companies over the long-term period, I expect this ETF to be going with the market with the same level as, say, S&P 500, which has around 10.5% annual growth, or even more than that. Their MER is also on a pretty low number, is at 0.25%, and this is very low compared to any other mutual funds, where the average fee for mutual funds, the average one, is 2.3%. And it's pretty hard to find those. Usually they are around 2.5 or 2.6, and they go all the way up to 4%. So this is definitely a very low fee ETF if you compare it to any other actively managed mutual funds. For example, Wealthsimple Invest, the robo-advisor, has a fee of 0.7%. Compared to this ETF, where you need to invest to a single ETF all the time, where they have a 0.25%. So you clearly win in terms of the fees going with the single ETF solution here. You can also go even further than that. You can just look at the stocks they have under this portfolio and directly invest into these stocks and sort of try to replicate what they're doing and keep watching what they're doing, what they're selling, what they're investing more into and all that. That way your fee is going to be 0%, but the other burden you're adding to your account now is this rebalancing and management that you got to be doing on your own, right? With this ETF, a single ETF solution, everything's going to be done for you. You don't have to worry about anything like that. This is basically a hassle-free investment. You're going with a single ETF solution. You cannot go further in terms of how easy it is. And you can use regular brokerage account like Questrade or Wealthsimple Trade to invest into these ETFs. You can find the link below in my description. Those are referral links, so I'm gonna get some bonus for that. And you also gonna get something on top of your regular signups. There's one other thing you need to know about this ETF, specifically this Vanguard Equity ETF. There is one other full equity ETF, which is VEQT, which is managed by BlackRock. And the major difference between these two ETFs is that the BlackRock VEQT full equity ETF has a management expense ratio of 0.2% compared to the Vanguard one we just talked about, where they have it at 0.25%. So other than that, they're pretty much the same. They both invest 100% into stocks, and they also both are pretty new, have only a couple years of history. And to my knowledge, or until today, there is no other companies who actually offer this full equity ETF single portfolio solutions. And if there is some other full equity single ETF portfolio solution on the market that I don't know about, let me know in the comments, happy to chat. I'll add it to my list, and also make sure to update my description to have it there as well. And now, is this the ETF for you? And if you are younger than 55 years old, totally, this is the one you want to use if you want to be very simple with your investments and you don't want to spend much time balancing, rebalancing, configuring your portfolio. This is the best one for your super simple investment profile. And if you're older than 55 years old, I would say you need to go with the growth ETF portfolio, which has a little bit of exposure into fixed income, but it's also on the aggressive side. And also, if you're totally okay with that, if you're very risk intolerant, then I would go with the balanced or conservative. If you're very close to your retirement age or to the age where you actually start using your investments. And that covers everything for these full equity ETF portfolios. I hope you learned something. Let me know in the comments if you have any questions around anything, and happy to chat there. Also, don't forget to smash that like button, subscribe to my channel, hit the bell. That helps me a lot and helps the YouTube algorithm to promote my videos to the entire planet. That's what is my goal, to teach everyone about investments. I'll see you around. Stay safe out there. Cheers, bye.